Today's talk is about the smile, in particular the volatility smile. Is it real or imaginary? The volatility smile refers to the shape when implied volatility is plotted as a function of normalized strike price. When options are bought and sold, the traders tend to assign a lower volatility to options which are at the money, so with a normalized strike price near 1, and they charge more, they assume volatility is higher for out of the money options. Now, this pattern is usually viewed as something of a conundrum, and it violates a key assumption of the Blackshells model, which is that volatility is a constant. The Blackshells model simulates price using a Lognormal distribution with a single volatility, whose units are inverse square root of time, so it doesn't make sense to have a dependency on price change. The quantum model, in contrast, is obtained by quantizing an entropic force, shown by these arrows here. And as we've seen, the result is a quantum wave function which rotates around the real axis. And this wave function distorts when it's perturbed due to market imbalance. So if there's a large order, this will increase this rotation, which will displace the price, but it will also have an effect on the volatility. It adds a term where x here is the log price change and t is the time period over which the imbalance occurs. So this market imbalance affects price, but also volatility. But can you see this in actual data? Well, if you look at Lognormal data, so here we've simulated a financial time series using Lognormal data, and we've looked at price changes over a 21-day, representing a month period, volatility over the same period, plotted them. Those are the blue dots. If we bin that volatility into sort of separate bins for each kind of price change interval and look at the average volatility, it's completely flat as shown by that red line. This black line, the theoretical curve for the smile, is not seen in the data at all. But interestingly, if you look at actual stock market data, so this is for the S&P 500 volatility versus returns for 21-day period, so the same experiment but using actual market data, you do get the characteristic smile shape. And you see the same kind of thing if you look at other stock indices and stocks, currency pairs, and so on. There's this fairly persistent smile shape which appears. But so if this is true, this should have implications for option prices. When we talk about implied volatility, usually it refers to the volatility which is implied by the cost of options. But if the model is correct, then the cost should always equal the expected payout, in theory. So another test is to ask what volatility is implied not by traders' projections about the future, but by after-the-fact market outcomes. In other words, what is the correct volatility to use in the Blackshells model so that the option cost calculated from the formula equals the expected payout as determined from historical data? The Blackshells model again calculates option prices by assuming that the price distribution is log-normal. So if the theory is correct, then the market implied volatility, as we could call it, should just be that usual volatility, and the average option cost using this volatility should equal the average payout. So that's the theory. Let's have a look. So first of all, we're going to be doing this using straddle options. So these are a combination of a put option and a call option, and the payout is just the distance between the stock price and the strike price. So if our strike price is 1, then the payout is going to depend, you're sort of betting that the price is going to be, the payout gets higher as you get further away from that, but it's symmetric around that point. Now, if the Blackshells model is correct, then the average payout should equal cost, which is the dashed lines. The dashed line here is just a function of strike price. So, for example, if I normalize strike price as 1, the cost should be there. And if that cost is going to be lowest, and if we go like a little bit further out, we're going to get a higher cost. So that's the Blackshells model for a straddle option. And when you test it using the Lognormal data, it works perfectly, as you would expect, because it's being designed for that. So here the there's a blue line superimposed with a dashed line, which shows the correct price curve that you expect, and the red line is the quantum model, which doesn't work in this case. But for market data, when you put actual market data instead of that Lognormal data in, the Blackshells model cost is now much too high for an at-the-money straddle option, while the quantum model is now the much better fit. So here, again, we've simply put that formula in to the Blackshells model, run the usual Blackshells algorithm using the volatility, which is now dependent on the strike price. Okay, so to summarize, the volatility smile is often assumed to be caused by traders' subjective projections about asset prices. In other words, it's essentially a figment of their imagination. The quantum model, however, predicts a formula for the volatility smile, and the tests show that the formula works for plots of volatility versus price change. In the Blackshells model, which assumes constant volatility, therefore systematically misprices options. And option pricing can be improved by taking the smile into account. So the volatility smile is therefore definitely real, even if the oscillations which produce it in the model take place in the imaginary plane.